the 9 financial accounts every adult should master. And here's the deal. If you're like most people out there, you're probably missing one of these. There are 9 accounts that form the core of a solid financial life. And chances are most people are either underusing one or misusing another. Now, this show just isn't for beginners. And if your advisor hasn't walked you through all 9 or at least brought them up to you, you might be missing out. So here's the challenge. You can't build financial independence on a foundation of disorganized accounts, overlapping purposes, and reactive decisions. So oftentimes when I meet with people for the first time, they have too much cash in low yield accounts. They are neglecting tax efficiency. They're missing credit score optimization, and they're underfunding or not even understanding how health savings accounts or 529 plans are supposed to be used. But there's some good news. There's an opportunity here to build a simple strategic system. And if you master these 9 accounts, it can help you reduce your taxes, grow your wealth, and potentially unlock your door towards financial independence, also known as retirement. Now, the secret here is you want to give each account a role. Am I using it for cash flow, for a safety net, for credit, for tax planning, for retirement, for legacy? Whatever that may be, each account needs to be managed differently. And once you assign a role, you can then align your function to the goals. Do I need the money here in the next week, month, or year? Or do I need it in 3 to 5 years? Do I need it in 10 years? And so forth and so on. So here's the deal though. Like I mentioned, oftentimes many clients come to my office and they have 20 different accounts, or they have 4 different 401ks, all being allocated differently. Maybe they're overlapping, right? And they're not being, efficient for their financial plan. And what we do is we unravel all of that and we structure it. And we structure it where we consolidate where we can. And most importantly, we align it with their financial plan. Once that's accomplished, we can invest, or maybe they're retired, we can set up a withdrawal strategy that is both tax efficient and makes sense according to their long-term goals. So when you consolidate, simplify, I know 9 sounds like a lot. It really isn't once you get into it. Thank you to everyone that's tuning into Upticks. Our subscriber count continues to grow. If you want more content, simply subscribe to our channel. Give us a thumbs up, 5-star ranking. Those are greatly appreciated. And you can also follow me out there on Instagram. My Instagram is simply Jake_Falcon_CRPC. Also, if you prefer to read more content, I've got a book out there called Retiring Right, Smart Steps for Exiting Corporate America. You can go into the show notes and get your free ebook version if you want to download a copy, or check it out there where great books are sold on Amazon if you want to buy a physical copy. So here's what we're here. We're for the 9 core financial accounts, and this gets into my framework. And I want to start with maybe the obvious one is your checking account. And the purpose of a checking account is for daily transactions. Typically, this is where money is received. So if you have a paycheck, this is where you're depositing that money. If you get Social Security, it's where it's going into. And it's where you're paying your monthly bills, right? Maybe your mortgage, your heating and cooling bill, maybe your streaming services, whatever it may be. But this is, again, cash flow. And the key tip here is that you don't want to store large amounts of cash, because if your checking account is like my checking account, it's probably not paying you very much interest. And my big tip here is that I personally don't like using automation to pay my bills. Now, I get it. Sometimes it is easier. You certainly don't want to be late on a mortgage payment. I make sure that I get updates and alerts when that mortgage payment is paid. For one, I want to know that it's getting paid and taken care of, but also I want to feel that money exiting my account so that I have a firm grasp on my bills. You see, you don't want to automate your bills. You want to automate your savings so that you don't see it and that compounds and grows and you don't even have to think about it. My preference is actually to write checks, literally checks to my bills, so I can feel that money exiting my account. You want to work with a bank that, of course, has SIPC and FDIC insurance, so it's a reputable institution. And I like working with a local bank, whether you live in Kansas, Missouri, New York, Texas, or California, wherever it is. Maybe you can establish a relationship with your local bank, make sure it's credible, make sure that your deposits are insured. But you never know, you may need a loan, and it probably would be good to have some transaction history with a local institution. If you go to one of these large corporate banks, they're probably just going to see you as another account number, and you'll probably be less likely to get help if you need it. So I like using a local bank for my checking account. Number two are high yield savings accounts. Now, the purpose for this is your emergency fund, right? In excess of what you're spending. And then if you're gonna build a swimming pool or you're gonna go on vacation and you know you're gonna need the money in 3 months, 6 months, 12 months, a year, whatever that may be, that's what you want to use a high yield savings account. Now, you also want to make sure that it has FDIC insurance and that you're aware of any limits as far as protection is concerned. Now, in today's environment, you want to make sure that you're getting at least 4% or more on your yield. And there typically should be very low or no fees associated with this account. So, again, I like it for money that I know I'm going to spend, whether that's in 1 month or 1 year, because I don't want to risk that in the stock market. But I also don't want to leave that money just sitting in cash in my checking account, earning very little interest. So, this does require you to be an adult and play a little bit of an active role. If my checking account is getting low, I've got to go in there and move money from my health savings account into that checking account to reload it. So you want to make sure that it's easy and free to move money from this account, either from your checking into it or from the high yield savings into your checking. But again, target that 4%, very low or no fees, and use it for your emergency fund or money that you know you're going to spend here in the next year or two. All right, number three are credit card accounts. Very dangerous accounts, but the purpose here is to build credit. And if you're like me, you like earning the rewards or the perks. Now, the number one thing you've got to do with a credit card, and this may be obvious for many of you, is you always want to pay your balance in full. You do not, absolutely do not want to use a credit card to float you a loan. Interest rates are very high for credit cards currently, 20% plus, and that is a lot of money to pay on even a small balance. You don't want to use it to float a loan. So if you need money, there are other ways to borrow it. Don't use your credit card to borrow it. Now, I like using credit cards for strategic purchases because they normally cover some sort of protection, right? So again, I don't want to put my debit card out there on the internet. So if you're buying things online, I love using a credit card for that theft protection. And then you also want to check your rewards. You want to go out there and make sure that you're getting either cash back, or if you're a big traveler, you're getting travel perks. You've got to do a little bit of research, but it can go a really long way. One of the perks that's associated with my credit card, and I don't want to endorse any company here, however, they let me cash in my points and move it directly to a brokerage account where then I could turn around and invest the points. Of course, I would say that I'm an investment advisor. That's what I like to talk about. That's what I like to do. But my point is just understand your rewards. Make sure you're getting the max amount. Don't be scared to pay an annual fee for a credit card. As long as you're using it a lot and getting more bang for your buck, the points may far overcome the price that you have to pay for that annual fee. So you just want to weigh that, do your research. You don't want to have a lot of credit cards out there. Maybe you've got a few different types based on different merchants accepting different types of cards. Pay them off and keep your credit utilization below 30%. Like I said, you want to pay off those balances every month. Number four is a health savings account. This is arguably one of the most powerful tax planning accounts out there. And you can potentially get tax-free healthcare funding if you use a health savings account appropriately. Now, these things are pretty powerful in that they have triple tax benefits. That's right, 3 times. One, when you put money into a health savings account, you may be able to deduct those contributions from your taxes. Number 2, if you can invest the money, any money that you make along the way grows something called tax deferred, meaning you don't pay capital gains as you're making money. And then number 3, when you pull the money out, as long as it's for a qualified health expense, that's right, it comes out tax free. These are great long-term retirement health funds. And again, invest your balance. I wouldn't recommend you just spend it every year. I would invest it, take advantage of that tax deferred growth. And a lot of people get these mixed up with flex spending accounts where you have to use it or lose it. That's not the case with the health savings account. In fact, you could carry it on for many, many, many years. And when you turn 65, it actually turns into an IRA. So even if you don't need it for health expenses for some weird reason, I mean, I could see most people in their 60s having some reason to see a doctor and potentially needing this money. But if you don't need it, you can pull it out and there's no penalties. It is taxable then, so I wouldn't recommend doing that. But my point is, if you're eligible, and you've got to be in a high deductible health insurance plan to be eligible to contribute to health savings accounts, along with some other rules. But if you're eligible and you've got the means, I highly recommend you look at a health savings account. Very powerful tax planning tool. All right, number 5 would be 529 plans. Now, this is for your kids or even your grandkids. And the key here is you get tax advantage education funding, which is a pretty cool deal. Now, if you live in a state where you pay state income taxes, you may be able to deduct your contributions to 529 plans from your state taxes. Now, this varies from state to state, so I don't want to go into that in great detail, but you can use this money for K through 12, college, and now this is kind of like it's not a loophole, but now you may be able to even roll it over to a Roth IRA for the beneficiary. Now, again, there's certain rules that apply from the Secure Act, but it's definitely something that you should look into. And if your kid or grandkid gets a full ride or a scholarship and they don't need it, you can shift beneficiaries to another person, typically within your family. So again, 529 plans are great. You put money in, you potentially, if you're in a state income tax, you could deduct some of that potentially. The money again grows tax deferred. You don't pay capital gains. And as long as you use it for qualified education expenses, that money comes out tax free. All right, number 6, traditional IRAs or rollover IRAs. And again, the key here is that the purpose is long-term tax deferred retirement growth. These are retirement accounts and they should be used accordingly. But you got to be strategic with them. You want to understand, should I roll an old 401k into it? What are the pros and cons? And do I look at doing a Roth conversion or something else with the money? So again, they're great accounts for tax deferred growth. They're great for retirement because you typically can't access the money until you're 59 and a half or older. But you just want to be strategic. And again, if you have got too much money in an IRA or a rollover IRA, once you get into your 70s, age 73 or 75, based on when you were born, you're going to have to take something called a required minimum distribution. And if you've got $4, $5, $6 million all in an IRA, that required minimum distribution or RMD might be hefty. So again, you want to be aware of these accounts. They're great for tax deferred growth. They're great for retirement, but just be careful. You don't want to overfund it. You can't overfund it if you don't need as much money in there in your 70s. Which brings me to the next one that I've already alluded to. Is number 7 is the Roth IRA. Roth IRAs are fantastic for long-term growth and tax-free growth. The way a traditional IRA or rollover IRA typically works is that money has been pre-taxed. So the accounts have been funded pre-tax. They grow tax deferred. You pull the money out, it counts as taxable income. The Roth is the flip side of that. So you put money in after tax. So there are no tax benefits from funding your Roth. However, the money grows again tax deferred. And then when you pull it out, as long as it's eligible, that money can come out tax-free, and there are no required minimum distributions. You can also do backdoor Roth strategies if you make too much money. And again, this is a great account if you want to do tax diversification. That's right, I said tax diversification. We like using Roth IRAs for that. All right, then number 8 is one of my favorites. It's actually a taxable brokerage account. What I love about these is very flexible. There's no contribution limits. There's no distribution requirements. There's no limits. You tax every year based on the realized gains, but you can control that. You can strategize around that. It can be used if you retire early. If you retire at 50 or 54 years old, you can use it. And also, if you need to offset some gains, you can do something called tax loss harvesting or even charitable giving through the account. So again, I love taxable brokerage accounts. So if you're accumulating wealth or even if you're nearing retirement, my recommendation to many of my clients is to build up that taxable brokerage account because it could offer you a tremendous amount of flexibility as you approach retirement. All right, and then number 9 is the 401k plan or the employer retirement plan, simple SEP IRAs. These are the primary retirement accumulation vehicles. The key here is you want to max out contributions, including any catch-ups if you're over 50. You may have in-plan Roth options or after-tax contribution allowances. And then if you work at a publicly traded company, there's something called net unrealized depreciation. But my point here is the key, and this is probably obvious to many of you, is to get the match. So if you need to put in 8% to get a 3% match, please put in that 8%. Of course, you want to look at your financial plan, but normally free money or a match makes sense for a lot of people. Again, this show is not advice, but I highly recommend you take a look at that 401k matching. Make sure it's diversified. You can be very reckless with this, so just don't think that they're going to invest it according to your financial plan. You don't want to go into some default mutual fund. You want to make sure that the investment mix is aligned with your financial plan, that you're getting any matching or maxing out the contributions. and that this is a core part of your retirement planning strategy. All right, that's a lot that I went over. So here's a myth. Here's a myth I want to bust today. More accounts equals better diversification. And that's wrong. Actually, that myth is busted. There's just too many people that confuse quantity with strategy. So I don't want you to have 10 different 401k accounts. That might not be in your best interest. So the true myth is the more accounts you have, the better the planning, not necessarily diversification. So if you have fewer accounts, but you're intentional with them, that should lead you to better decisions. And so my point of today's episode is that each account should serve a specific function, not just exist on your balance sheet or in your financial plan. So let's do a quick recap on those 9 accounts, right? So number 1, checking account. This is for your daily cash flow. Number 2, you're going to use a high yield savings account to make sure that your excess cash is making you at least 4%. Again, this is as of August of 2025. So you want to make sure that that's around 4%. Credit cards, we're using those for safety and protection and for online purchases, and we pay those suckers off every month, and we're getting the most rewards that we can from our card program. Health savings accounts are number 4. Again, this is a great way to set up healthcare in retirement. That's one of the biggest hurdles people talk about for retirement, and this is a way that you can plan for it using a health savings account. Number 5, if you got kids or grandkids, a 529 plan may make sense for their college savings, and it could help you with your tax planning. Number 6, IRAs or rollover IRAs. Again, this is just consolidating old 401ks, making sure that everything is working for your best interest according to your financial plan. Roth IRAs are great for tax diversification. In there, a taxable brokerage, I love it. That's number 8 for your flexibility. And then number 9, that 401k, especially one with a matching contribution. The key here is to keep your money organized by time horizon and tax treatment. It really, really helps to have a financial plan. With our clients at Falcon Wealth Advisors, we list out all of these accounts in their financial plan, and then we have a goal attached to that so that we make sure that all of the assets are being utilized appropriately. So here's my call to action. If you want to know if your current accounts are working together, or maybe they're holding you back, simply email Luke at falconwealthadvisors.com, and Luke will set up a time to meet with me to go through our signature planning process, which consists of 2 meetings, both of which are confidential and both of which are complimentary, where we will help you get your money organized. We'll figure out what accounts do you have, maybe what accounts do you need to consider opening to make sure that everything is lined up. Be sure to subscribe to Upticks for more clarity, more confidence, and smarter money decisions. Thank you again for tuning in. I'm your host, Jake Falcon, and I hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website at www.falconwealthadvisors.com and click the Contact Us button if you'd like to meet with Jake and his team.